You're finally ready to start investing. You've got some money saved, you've opened an investment account, and now you're staring at the screen trying to decide what to actually buy. And immediately, you're hit with a choice that sounds simple but feels confusing. Stocks or mutual funds? You've heard both terms 1,000 times. You know they're both investing, but what's the actual difference? And more importantly, which one should you be putting your money into? My name is Zach, and I help people cut through financial confusion and understand what's actually happening with their money. And here's the frustrating truth. Most explanations of stocks versus mutual funds are either way too technical or they skip over the details that actually matter for making a decision. So I'm going to break this down in the clearest way possible, explain what each one actually is, and help you figure out which makes sense for your situation. Let's start with stocks, because that's the simpler concept. When you buy a stock, you're buying a tiny piece of one specific company. That's it. You're not buying the whole company, obviously. You're buying shares, which are just units of ownership. If you buy 10 shares of Apple, you own a microscopic percentage of Apple. If Apple does well, your shares become more valuable. If Apple struggles, your shares lose value. Your financial fate is tied directly to that one company's performance. Here's what that looks like in practice. Let's say you've got $5,000 to invest, and you decide to buy stock in Microsoft. You check the price, let's say it's $400 per share. You can afford 12 shares with a little money left over. So now you own 12 shares of Microsoft. That's your entire investment. If Microsoft releases an incredible new product and the stock jumps 20%, you just made $1,000. If Microsoft gets hit with a massive lawsuit and the stock drops 15%, you just lost $750. Every dollar you invested is riding on this one company. That concentration is both the opportunity and the risk. Individual stocks can absolutely explode in value. Netflix is up something like 40,000% since 2002. Amazon is up over 150,000% since its IPO. If you'd bought $1,000 of Amazon stock in 1997 and held it, you'd have over $1 million today. That's the dream everyone's chasing. But here's the other side. Thousands of companies have gone to zero. Blockbuster, Sears, Lehman Brothers, Enron. People who owned those stocks lost everything they invested. Individual stocks can make you rich or wipe you out, sometimes in the same year. Now let's talk about mutual funds, because this is where people get confused. A mutual fund is not a single investment. It's a basket of investments. When you buy into a mutual fund, you're pooling your money with thousands of other investors, and a professional fund manager uses that collective money to buy dozens or hundreds of different stocks, bonds, or other assets. You own a tiny slice of that entire portfolio. Here's a concrete example. Say there's a mutual fund called the Large Cap Growth Fund. The manager of that fund takes everyone's money and buys stock in maybe 100 different large growing companies. Apple, Microsoft, Google, Tesla, Nvidia, whatever fits the strategy. When you invest $5,000 in that mutual fund, you're not buying shares of one company. You're buying a piece of all 100 companies at once. If one of those companies tanks, it barely affects you because it's only 1% of your holdings. If another one skyrockets, you benefit from that too. Your investment is spread out. That's called diversification, and it's the main reason mutual funds exist. Instead of betting everything on one or two companies, you're spreading risk across many. You're not going to get those insane 40,000% returns, but you're also way less likely to lose everything if one company implodes. Now here's where it gets more specific, because there are different types of mutual funds, and understanding the distinction matters. Some mutual funds are actively managed. That means there's an actual person or a team of people researching companies, making decisions about what to buy and sell, trying to beat the market. They're getting paid for that work, usually around 1% of the fund's total value every year. That fee comes out of your returns automatically, whether the fund does well or not.
Then there are index funds, which are technically a type of mutual fund but work differently. Index funds don't try to beat the market. They try to match it. They automatically buy all the stocks in a particular index, like the S&P 500, which tracks the 500 largest companies in America. There's no human making judgment calls. The fund just mirrors whatever the index does. Because there's no expensive fund manager, the fees are way lower, often 0.1% or less annually. And here's the uncomfortable truth for the actively managed funds. Most of them don't actually beat the index over long periods of time. After fees, something like 80% or 90% of actively managed funds underperform a basic S&P 500 index fund over 10 or 20 years. So why would anyone use an actively managed fund? Sometimes people want specialized exposure, like a fund focused only on healthcare stocks or emerging markets or socially responsible companies. Sometimes they genuinely believe a particular manager has skill. But for most regular investors, index funds have become the default recommendation because they're cheaper and historically perform better than the expensive alternatives. Let's talk about what this choice actually means for you. If you buy individual stocks, you need to know what you're doing. You need to research companies, understand financial statements, follow news, watch earnings reports. It's work. And even if you do all that work, there's no guarantee you'll pick winners. Professional investors with entire research teams get it wrong constantly. The guy managing a billion-dollar hedge fund gets it wrong. What makes you think you'll consistently get it right scrolling through Reddit and CNBC? I'm not saying it's impossible. Some people genuinely enjoy researching companies and building a portfolio of individual stocks. If that's you, great. But most people don't have the time, interest, or skill to do this well. And the consequences of doing it badly are real. You can underperform the market by a lot. You can lose significant chunks of money on bad picks. Mutual funds, especially index funds, are the opposite. They're boring. There's no thrill of picking the next Amazon. But there's also no stress of watching one of your picks drop 60% because the CEO got caught in a scandal. You're basically saying, I want to own a piece of the entire market, grow with the economy over time, and not think about this constantly. For most people, that's the right choice. Here's the math that makes this clear. Let's say you invest $10,000. Path 1. You pick 5 individual stocks. 3 of them do okay. 1 goes up 50% and 1 goes to 0 because the company fails. Your overall return is maybe 8% after a year of stress and monitoring. Path 2. You put that $10,000 in an S&P 500 index fund. The market goes up 10% that year. You made 10%, paid almost no fees, and didn't think about it once. Over 20 or 30 years, that difference compounds into hundreds of thousands of dollars. There's also the emotional component nobody talks about. When you own individual stocks, you feel every swing. The stock drops 5% in a day, and you're refreshing your portfolio app wondering if you should sell. It goes up 8%, and you're wondering if you should take profits. That emotional roller coaster leads to bad decisions. Selling low out of fear, buying high out of greed. Mutual funds smooth that out. The whole fund doesn't swing as violently because it's diversified. You're less likely to panic and make emotional mistakes. Now, here's what you actually need to consider when choosing. If you've got significant time to research, genuine interest in individual companies, and money you can afford to lose if you're wrong, buying individual stocks can be rewarding and educational. It's also fine to do both. Put 80% or 90% in index funds for stability, and use 10% or 20% to pick individual stocks for the learning experience and potential upside. But if you're like most people, you've got a job, a life, other responsibilities, and you just want your money to grow reliably without becoming a part-time stock analyst, index funds are probably the answer. They're simple, cheap, historically effective, and they let you actually live your life instead of obsessing over earnings reports. The financial industry has spent decades making this seem more complicated than it is because complexity sells expensive products. But the reality is pretty straightforward. Individual stocks are concentrated bets on specific companies. Mutual funds are diversified bets on the broader market. One has higher potential returns and higher risk. The other has moderate, reliable returns and lower risk. Neither is inherently better. They serve different purposes for different people. What matters most isn't which one you pick. What matters is that you actually start investing, that you do it consistently, and that you don't let confusion or fear keep your money sitting in a checking account, earning nothing while inflation slowly eats it away. Because whether it's stocks or mutual funds, the act of putting your money to work is what builds wealth over time. Everything else is just details.